We're so glad you could join us. Our whole mission here is to cut through the noise, the complexity of these incredibly dense documents, financial filings, market research, and just distill it all down into the most interesting conversation you'll have all week.
That's the goal. And today we are taking a very sharp scalpel to one of the big ones. Amazon's quarterly report on Form 10Q for the quarter that ended September 30, 2025.
And this isn't just a financial report, right? It's more like a strategic roadmap. It tells you exactly where one of the world's most powerful companies is placing its, well, multi-billion-dollar bets for the next decade.
For sure. I mean, these filings, the unaudited financials, the management discussion, all the risk factors, they can be notoriously difficult to get through.
Yeah, time-consuming is an understatement. But our job today is simple. We're going to slice through all the accounting jargon, all the legalese, and we're going to isolate the most important insights for you. And maybe most importantly, explain the why behind the numbers.
Right. Think of this as your shortcut to being really genuinely informed on the state of Amazon right now. We're going to show you where the money's being made, where they are strategically losing cash to build for the future, and how this massive paper gained from an AI investment completely, and I mean completely, skew the headline numbers.
It really did. And before we dive into all of that, the infrastructure spend, the legal charges, the AI bets, please do us a huge favor. If you find this kind of analysis valuable, if it helps you get smarter faster, please go ahead and hit that like button.
Yeah, share this with a friend or a colleague.
And subscribe to the channel. It genuinely helps us keep delivering this kind of focused deep dive directly to you.
Okay, so let's get into it. Let's unpack the core paradox of Amazon's Q3. Because the headline numbers, they're on the surface, it looks spectacular.
Yeah.
But they're also deeply misleading.
That's the hook, isn't it? That's what immediately jumped off the page for me. You see net income just surging. I mean, a massive, nearly 38% year-over-year increase. And you think, wow, what a quarter. They're just firing on all cylinders. But then you look one line up on the income statement at the core business performance, and the operating income was basically flat, virtually unchanged from last year.
Exactly. We're talking about a total consolidated operating income of $17.422 billion in Q3 of 25. And you compare that to Q3 of 24, it was $17.411 billion.
So that's what, a difference of $11 million on revenue that grew by more than $21 billion.
Precisely. That flat line is your first huge red flag. It's an immediate indicator of some really intense internal pressures on the business.
And when net income just skyrockets like that, by 38% while your operational profit is standing still, the math only points one way.
Yep.
The extra profit didn't come from selling more books or running AWS servers more efficiently. It came from somewhere completely outside of the day-to-day operations.
It's all about non-operating gains. We're talking colossal financial gains tied to strategic non-cash valuation adjustments. And the big one, the one that drove almost all of it, relates to their investment in the AI firm, Anthropic.
So you have this one paper gain that polishes up what was otherwise a really expensive, really high-pressure quarter for the company. So to put it all together, what we're looking at is a company that's dealing with billions in one-off operating costs, things like legal settlements, restructuring, while at the same time, it's aggressively pouring billions more into infrastructure.
Right.
But it still manages to post this spectacular headline profit. And it's all because of an upward valuation of a minority investment they hold. This 10Q, it's just a crystal clear map of where Amazon thinks the next generation of profit is. And it has a lot less to do with shipping you a box faster and a lot more to do with dominating the foundational layer of artificial intelligence.
That is the whole story in a nutshell.
Okay, so let's start at the top, the financial snapshot.
Right. So to summarize this 10Q in plain English, it's a quarterly report the SEC requires. It gives you the unaudited financial statements, management's detailed discussion of what happened, and crucially, a big section on risks.
And the core narrative here is just, it's a story of contrasts.
It really is.
Yeah.
The core narrative is that Amazon is still growing its top line relentlessly. I mean, double-digit growth. But it's doing it at a cost that is basically eating up all of the gains from that growth.
It is a fascinating study in financial strategy, isn't it? You've got this massive revenue engine just running at full tilt, generating incredible cash from operations. But then management is making a very clear, very deliberate choice to immediately divert almost all of that operating cash right back into future infrastructure. They're not trying to maximize free cash flow today.
Not at all. They're optimizing for future market share, for dominance down the road.
Okay, so let's ground this with the key numbers. These are the figures from Q3 2025 that really frame the entire conversation we're about to have.
Okay.
Okay. First, revenue or total net sales, $180,169 million. That's a very healthy 13% consolidated growth year over year.
Which is incredible at that scale.
It is. Next, net income, $21,187 million. And as we said, that's the number that surged, up almost 38% from last year's $15.3 billion.
The headline grabber.
Exactly. Then you have your earnings per share. Basic EPS came in at 198 cents. Diluted EPS was 195. And then the big one, operating margin. That's your operating income divided by your net sales. That came in at 9.67%.
And that operating margin figure, that's where you really see the pressure.
Yeah.
Because if you look back a year to Q3 2024, the operating margin was 10.95%.
Okay, so sales are up 13%, but the margin actually compressed.
I compressed by 1.28 percentage points in just 1 year.
And a drop of 1.28 points on $180 billion in sales is not a small number.
Not at all.
If they'd held that 10.95% margin, their operating income would have been, what, almost $2.3 billion higher?
Something like that, yeah. So it tells you that all that new revenue was immediately offset by higher costs and then some. The money went somewhere, and that somewhere was very expensive.
And what are they telling us about the next quarter, the holiday season?
They're still very bullish on sales. The guidance they gave for Q4 is net sales between $206 and $213 billion. So that's forecasting another 10 to 13% growth.
Okay, still strong on the top line. What about operating income?
That's the interesting part. The guidance for Q4 operating income is a huge range, from $21 billion to $26 billion.
Wow, a $5 billion range.
Yeah, and that wide range is basically an admission of how volatile their spending is right now.
Yeah.
They're saying, look, we expect huge holiday sales, but our costs, the CapEx, the depreciation, the payroll, it's so intense that we can't pin down the profit number any closer than that.
It's all being actively managed quarter to quarter.
Exactly. So with that as the backdrop, let's synthesize all this down into the 5 most important takeaways that really define this 10Q. These are the themes for our deep dive.
Okay, let's lay them out. The 5 key themes for Amazon's Q3 2025. Number 1, the AI windfall. That spectacular net income number was, frankly, artificially inflated. It came from non-cash, non-operating gains, mostly the upward valuation of their investment in the AI firm Anthropic. You pull that out and the whole picture changes.
Right. Number 2, accelerated infrastructure investment. Capital expenditures, or CapEx, just soared to levels we've never seen before. And the focus is squarely on building out data centers for AWS, especially for AI and machine learning.
Number 3, retail profit pressure. The North America segment, their home base, actually saw its profit dip year over year, and it wasn't a sales problem, it was a cost problem, driven by huge one-time charges like an FTC settlement and a lot of severance costs.
Good summary. Number 4 is that despite all that, strong top-line growth continues. The core business is still very robust. Consolidated sales grew 13%, and the real engine, AWS, grew at 20%. It's still driving the whole enterprise.
Which leads to number 5, deterioration of free cash flow. And this one is maybe the most dramatic metric in the whole filing. Trailing 12-month free cash flow absolutely plummeted, and it's a direct result of that massive CapEx surge. Amazon is choosing dominance tomorrow over cash today.
And if you take those 5 points together, they tell a story of a mature giant that knows it's at an inflection point. The strategy is clear. Use the incredible profits from AWS, supplement them with these strategic financial gains like Anthropic, and just pour it all into making sure you own the next war, which is the AI infrastructure war. It's a huge multi-billion-dollar bet.
Okay, so let's start with that core engine then. Let's talk about AWS and this investment mega cycle.
Yeah, let's break down the segment performance first, because the disparity is it's huge.
Okay.
So North American net sales, $106.3 billion, that's 11% growth.
Yeah.
International net sales, $40.9 billion, 14% growth. And then you have AWS net sales, $33 billion. But it grew at 20% year over year.
So AWS is the clear growth champion. It's growing faster than the retail segments, which is exactly what you want to see because that's the high margin business.
Exactly. But the really critical detail isn't just the growth. It's the profit leadership from AWS.
The profit concentration.
Yeah, absolutely. When you look at operating income, AWS brought in $11.4 billion in Q3. Now, you compare that to the entire company's consolidated operating income, which was $17.4 billion.
Wow. So if my math is right, that means AWS generated something like 65% of Amazon's total operating income,
Oh.
even though it was only about 18% of the total sales.
It's staggering, isn't it? It just underscores that AWS isn't just another business unit. It's the financial backbone of the company. It's the engine that funds everything else, every experiment, every retail expansion, and especially this massive CapEx cycle we're seeing.
And that profit engine needs to be fed.
Constantly and aggressively. Which leads us right into the CapEx explosion, this enormous intentional investment mega cycle that's going on.
The numbers here are just, they're hard to get your head around. The raw cash capital expenditures, so money spent on property and equipment, hit $34.2 billion in this one quarter.
Just Q3.
Just Q3. And to give that some context, in Q3 of last year, it was $21.3 billion, so that's a jump of over 60% in 1 year.
That one quarterly spend, that $34.2 billion, is larger than the annual GDP of a lot of smaller countries. It's a mind-boggling amount of money.
And the 10Q is pretty specific about where it's going, right?
Very specific. It says it's for investments in technology infrastructure, and then in parentheses, the majority of which is to support AWS business growth and also for the fulfillment network. But the emphasis is clearly on AWS.
And we can see that in the segment data. The AWS segment alone recorded $28.3 billion in net additions to property and equipment in Q3.
A generational commitment.
It's focused on data centers, networking gear, and you have to assume the very specific hardware you need for advanced AI processing. It's a global race to build out cloud capacity for things like large language models.
And that relentless spending brings us to a really crucial and kind of hidden cost. It's buried deep in the accounting notes, but it tells you so much about how fast Amazon thinks this AI technology curve is moving.
Okay, so this is the change in accounting estimates. I know accounting notes can sound dry, but they're often where the real story is. Why would they change the estimated useful life of their equipment?
So, effective at the start of 2025, Amazon announced they were shortening the estimated useful lives for a subset of their servers and networking equipment. They took it down from 6 years to 5 years.
And if the useful life of an asset goes down, that means your depreciation expense goes up. You have to write it off faster.
Exactly right. Faster depreciation means higher non-cash operating costs hitting the income statement sooner. But the really crucial part is the reason they gave in the 10Q. They cited the increased pace of technology development, particularly in the area of artificial intelligence and machine learning.
So they're literally saying on the record that the hardware they're buying right now, the expensive GPUs, the custom AI chips, it's all becoming obsolete faster than ever before.
Yes, this isn't just some conservative accounting move. It's a competitive admission. The AI arms race is forcing them to write down the value of their own high-tech gear sooner because the next generation of silicon is making the current stuff redundant faster.
Whether it's from NVIDIA or their own custom chips like Trainium.
Right. And this change has a real immediate financial impact. In Q3, it increased depreciation expense by $392 million. And that, in turn, reduced net income by $298 million. And the filing says this impact primarily hit the AWS segment.
That is just a huge operational insight hiding in a footnote. That $298 million hit is the cost Amazon is willing to eat because they know they can't afford to run their customers' AI models on what will very soon be second-rate hardware.
And think about the competition. Microsoft Azure, Google Cloud, they're all facing the exact same pressure. This accelerated hardware obsolescence is going to hit their income statements too. It just compresses margins for everyone in the cloud business.
It changes the entire pricing model. You have to make sure you're earning back the cost of that incredibly expensive hardware over a shorter 5-year window now.
It is the very definition of a hot infrastructure megacycle.
So that brings us back to the central paradox of the quarter. Great top-line growth, flat operating income, but spectacular net income. And we know the differences on that non-operating line.
Yeah, that spike in total non-operating income is just monumental. It went from about $600 million in Q3 of last year to an incredible $10.7 billion in Q3 of this year.
$10.7 billion. That spike alone is almost half of the quarter's entire reported net profit.
And the 10-K tells you exactly where it came from. $10.2 billion of it came from one line item, other income expense net. And if you drill into the notes, you find out it's almost entirely related to Amazon's investment in Anthropic.
Anthropic. For anyone who doesn't follow this closely, they are one of the top AI foundation model companies,
Yeah.
a direct competitor to OpenAI and Google DeepMind. So a financial transaction, a paper gain related to an AI investment, is what made Amazon's Q3 headline profit look so good. Not selling things, not running servers.
It's a textbook example of a non-cash gain dominating the story. And that $10.2 billion gain from Anthropic is broken down into two technical pieces, which really helps you understand the nature of it.
Okay, let's break those down because it's key to understanding that this isn't cash.
Okay, first, the biggest piece. A massive $7.2 billion gain from an upward adjustment. This is all about the fair value of Amazon's non-voting preferred stock in Anthropic. Basically, because of new funding rounds or other market signals, the estimated value of their stake went up by $7.2 billion.
So an analogy might be helpful. It's like if you bought a piece of a private startup for $1 million, and then a year later, that startup raises more money at a much higher valuation. The value of your stake on paper might now be, say, $8 million, but you haven't sold anything. No cash has come to you.
Perfect analogy. It is a paper profit. It only becomes real cash if and when they sell that stake in the future.
And what was the second piece?
The second was a $2.3 billion gain from a reclassification adjustment. This happened when some of Amazon's convertible notes in Anthropic were converted into that preferred stock. It's an accounting rule that says when that conversion happens, you have to move the unrealized gain from the balance sheet to the income statement.
But the key takeaway is the same for both.
Absolutely. Both are non-cash valuation gains. It proves that the extraordinary net income number is totally decoupled from the operational performance of the business. It's just management successfully monetizing a strategic relationship through accounting.
And it's important to remember the scale of Amazon's total bet on Anthropic. This isn't a small side investment.
Not at all.
Yeah.
They had previously committed $5.3 billion in convertible notes. They added another $1.3 billion in Q2, and the 10Q says they're putting in another $1.4 billion in Q4. This is a foundational relationship.
And it's a commercial relationship, too, which ties it all back to AWS.
Exactly. The investment is explicitly linked to a commercial deal where Anthropic agrees to use AWS for its cloud services and, crucially, agrees to use Amazon's own custom AI chips, like Trainium and Inferentia.
Okay, so let's trace that strategic loop. It's really elegant. Amazon commits billions to Anthropic. The market sees Anthropic's success, which leads to billions in paper gains for Amazon, propping up their net income.
Right.
And at the very same time, Anthropic becomes a huge dedicated customer for AWS, driving massive demand for those brand new multi-billion-dollar data centers.
And that demand drives up AWS revenue and profit, which helps offset the very depreciation costs that AWS is now facing because of the AI arms race we just talked about.
It's an incredibly smart circular strategy. They're not just investing in an AI company, they are creating guaranteed demand for their own platform. That Anthropic gain isn't just a number, it's a validation to the market that says, hey, this massive, expensive CapEx cycle we're in, it's working, we're backing the right horse.
Well said. It's a powerful signal.
Okay, so we've explained the fantastic net income number. But to understand the true health of the core Amazon business, we have to look at where the costs were hitting. And that brings us back to the retail side.
Yeah, the pressure on the North America operating income it's profound. The segment's profit dropped from over $5.6 billion in Q3 last year to under $4.8 billion this year.
So that's almost $1 billion decrease in profit.
Despite an 11% growth in sales for that segment, it's a huge drop.
Which tells you that even though they sold more stuff, the North America retail operation became a lot less profitable this quarter. And that was driven by two very large one-time charges.
These charges were so big, they basically wiped out all the profit that should have come from the extra $10 billion in sales they had.
So what was the first big hit?
The FTC settlement charge. Amazon recorded a $2.5 billion expense to settle a lawsuit with the Federal Trade Commission.
$2.5 billion. That's a huge penalty and a major signal about the cost of all this regulatory scrutiny.
For sure. It was recorded in other operating expense and hit the North America segment directly. And what's important here is that it shows these legal risks are no longer hypothetical things in the back of the report. They are now concrete material costs hitting the income statement.
And it's not just this one settlement. The 10Q spends a lot of time talking about ongoing legal challenges all over the world. Antitrust, price fixing.
Everywhere. They mention active cases from private litigants, from state attorneys general, the FTC in the U.S., Canada, the U.K. It's a global legal battle, and this $2.5 billion might just be the tip of the iceberg.
They even mention a big fine in Italy, right?
Yeah, an appeal that's pending for a fine of over 750 million euros. They've already paid a larger fine and are trying to recover it. But the point is, the time, the resources, the legal fees required to fight these battles on 3 continents is just immense.
Okay, so that's the legal cost. What was the second major pressure point?
The second was restructuring, corporate streamlining.
Right, the severance costs.
Exactly. The filing highlights $1.8 billion in estimated severance costs in Q3 from planned role eliminations. This points to a very large strategic culling of certain corporate and tech roles.
And unlike the FTC charge, this one was spread out across the whole company.
Yep. It hit technology and infrastructure, sales and marketing, and general and administrative. It impacted all the segments. This is evidence of a big streamlining effort, probably to get more efficient as they pivot even harder toward this AI-driven infrastructure model.
So it sounds like they're pruning the workforce in some areas to free up resources to hire more aggressively in high-growth areas like AWS and AI.
That's exactly what it looks like. Which brings us to a really telling comparison you can make in the numbers, the contrast between cost efficiency and spending intensity.
And this really reveals their priorities. On one hand, you have the physical logistics machine. Fulfillment cost picking, packing, shipping, they actually went down slightly as a percentage of sales, from 15.5% last year to 15.4% this year.
And that tiny 0.1 percentage point drop on $180 billion of revenue is actually a big deal. It suggests they are getting more efficient in their fulfillment network. Their regionalization strategy might be paying off.
But those small efficiency gains were immediately swamped by the explosion in future-focused spending.
In sharp contrast, yeah. The technology and infrastructure costs, so running AWS R&D, corporate engineering payroll, that line item rose sharply. It jumped to 16.1% of net sales, way up from 14.0% a year ago.
That one metric just summarizes the entire strategy, doesn't it?
It does.
The little bit of money they saved by optimizing the physical supply chain was instantly swallowed, and then some, by the intense spending needed to build the future tech platform.
The shift is unmistakable. They're squeezing efficiency out of the old business so they can afford to subsidize and build a new one. It's just the cost of staying on top in 2025.
So a strategy this intense, this capital intensive, it all comes down to cash flow. And the most dramatic number in this entire report has to be the collapse of free cash flow.
It's the metric that really defines the risk of this strategy. Free cash flow is the cash you have left after you run your business and pay for all your big investments. And the numbers here are, they're stunning.
Trailing 12 months free cash flow fell from $47.7 billion in Q3 of last year, all the way down to $14.8 billion in Q3 of this year.
A drop of almost $33 billion in a single year. For almost any other company, that would be a catastrophe.
But for Amazon, it's a choice.
It's a choice. It's a direct consequence of the massive investments in property and equipment. Management is signaling, as clearly as they possibly can, that they are prioritizing generational growth investments over near-term cash generation.
It's a calculated high-stakes bet on the future of computing, not reckless spending.
And it's a bet that's being helped along by changes in U.S. government policy. Let's talk about the tax development mentioned in the 10Q, the One Big Beautiful Bill Act of 2025.
That's a name. What did that legislation actually do for Amazon?
Well, the key thing for a company like Amazon is that it reinstated 2 huge tax benefits retroactively. First, 100% accelerated depreciation, and second, the immediate expensing of domestic R&D costs.
Okay, so in simple terms, it lets them deduct the cost of all those new data centers and servers much faster for tax purposes than they can for their regular financial reporting.
Exactly. And that creates this kind of weird effect on their books. The filing says the Tax Act actually increased their income tax provision, the expense on the income statement.
Wait, a tax break increased their reported tax expense? That seems backward.
It is counterintuitive. But this is where the difference between the accounting provision and the actual cash you pay is so important. While the reported expense went up for some complicated international tax reasons, the really vital part is that the law is expected to significantly decrease our cash taxes in 2025.
So what they report as an expense and what they actually hand over to the government are 2 different things, and the cash they handed over went down.
Way down. You can see it on the cash flow statement. Cash paid for income taxes dropped from $2 zillion in Q3 of last year to just $1.1 billion this year. They saved almost $1 billion in cash tax payments in 1 quarter.
And that lower cash payment helps cushion the blow from the massive CapEx spending.
Absolutely. It acts as a kind of indirect subsidy for this huge investment cycle.
But even with all this spending, their overall financial position is still solid, right? They're not going broke.
They're not even close. Their balance sheet is a fortress. They had $94.2 billion in cash and marketable securities at the end of the quarter. They just renewed a $5 billion credit facility. They have no borrowings outstanding on their major credit lines. They have plenty of liquidity.
Okay, so let's wrap up by touching on the risks they're flagging. What are they telling the world they're worried about?
The core risks are getting more intense, not less. Intense competition is number one. They specifically call out new technologies like AI, satellite networks, and healthcare as increasing the pressure. They know they're in a multi-front war.
And the international risks seem to be growing.
Yeah, they flag geopolitical issues and regulations in two key markets, China and India. In China, they have to rely on local partners, which adds uncertainty.
And India is a tax headache.
A big one. They're fighting some major tax assessments there related to cloud service fees. If they lose, it could cost them hundreds of millions, maybe billions. These fights in Italy, in India, with the FTC, they just show that regulation is now a material cost of doing business.
And they even mentioned their own stock price volatility as a risk.
Because the market just struggles to value a company that's a retailer, a cloud provider, a movie studio, and an AI infrastructure builder all at once. That volatility makes everything harder. This 10Q is basically an acknowledgement that the world is getting more complex and more threatening, not less.
Okay, so let's bring this all together. Let's try to find a succinct conclusion for this deep dive. Amazon's Q3 2025 really feels like a tale of two different, almost contradictory realities.
I think that's right. On the surface, you have this spectacular quarter for net income, but it was driven almost entirely by a non-cash paper gain from their AI investment in Anthropic, a really important validation of their strategy, but not an operational win.
And then underneath that shiny number, the core business was dealing with huge, deliberate cost increases. Everything from the FTC settlement and severance costs to that unprecedented spending on cloud and AI infrastructure.
They are deliberately taking these hits now, like the accelerated depreciation on servers, because they believe it's what's necessary to ensure they dominate the market for years to come.
The ultimate takeaway for me is that Amazon is just playing the long game, above all else. They're consciously sacrificing clean, immediate cash returns for these gargantuan, future-proofing investments that they believe will define the next chapter of the economy.
Which leads us to the final thought, the provocation for you, the listener. That plummeting free cash flow from almost $48 billion down to under $15 billion, that is the clearest sign that management is betting the farm on the long-term payoff of AI and infrastructure dominance. The critical question now is, how long will investors tolerate SCF being near zero? And more importantly, what metrics will management use to prove that this massive capital campaign is actually paying off in core operating profits, not just in these paper gains from strategic bets?
That is the real test for the next phase of Amazon's growth. A powerful question to end on. Thank you so much for joining us on this deep dive into Amazon's future. If you found this conversation insightful, please take a moment to click that like button, share this, subscribe, and stay tuned for our next one. We'll continue to turn complex data into knowledge you can use. We'll see you next time.